Thank you, Deepa. Um, Good morning, everyone. Firstly, I would like to thank all the attendees who've taken out time from their busy schedule to join us for this webinar series we are starting. So, I am Vatsala Khare, the lead of mentorship program at SISC IIT Kanpur. We are live with Mr. Vaibhav Lodha for this webinar series that we are proposing on financial sustainability. And you can find this the link of this video on our YouTube handle of SISC IIT Kanpur. I will share the recording also in case if anyone needs it. So, as I told you that the topic for today's webinar is financial sustainability for startups. Today, we will be trying to focus on how to develop a solid business plan with detailed financial projection and the market analysis. We are doing this as a series as a series on financial sustainability, and we'll be covering various topics under this. If any of our startups has any specific request to be covered under this webinar series, please let me know. Now I'd like to briefly introduce our speaker of today. Our speaker is Mr. Vaibhav Lodha. He is a prominent entrepreneur and a social innovator known for his work in the fields of financial inclusion, technology, and social impact. He co-founded FT Cash, which is a fintech company aimed at empowering micro merchants and small businesses by providing them with easy access to financial services such as loans and digital payments. Through FT Cash, Vaibhav has significantly contributed to the enhancement of financial inclusion in India, helping small business owners manage their finances more efficiently and grow their enterprise. We are also obliged to Weber for being there on our prestigious mentor pool of SISC IIT Kanpur. Weber's journey in entrepreneurship is marked by his dedication to solving pressing social issues through innovative solutions. Before founding FT Cash, he held significant roles in various organizations. He has worked with World Bank, where he was focused on global economic policies, and with XPRIZE Foundation, where he contributed to the development of incentive competitions to solve humanity's grand challenges. He is an alumnus of prestigious institutions. He holds degrees from Massachusetts Institute of Technology and University of Mumbai. Throughout his career, he has received several accolades for his contributions in the field of fintech and social entrepreneurship. Some of the notable awards I'll just share with you all have been Forbes 30 Under 30 Asia 2017. He was recognized in finance and venture capital category for his impactful work there in fintech, that is financial technology and inclusion. The others are India FinTech Awards in 2018, United Nations FinTech Challenge 2019, and there are many more feathers to his cap. So, in addition to these awards, Weber is recognized as a thought leader and frequently speaks at international conferences and forums on topics related to financial inclusion, technology, and innovation. In addition to his professional pursuits, Weber is passionate about mentoring young entrepreneurs and supporting initiatives that drive social change. His work continues to inspire many in the fields of business and social innovation. Please requesting all the participants to make this webinar interactive with your questions for your own benefit. Please type your queries in the question answer chat box. I will take it up during the webinar. Weber, the floor is open for you.
Thank you so much, Vatsala. That was very elaborate. Maybe we can do it short next time. So, hello everyone. Very nice to meet every one of you. Initially, I thought like I'll probably try and get the introduction of everyone during the session as well, so that I also understand what kind of what your understanding of financial stability is, or financial sustainability is, and what challenges are you.
Vaibhav, you just went on mute.
Because rather than me trying to give theoretical uh, knowledge, it's better to be a little more practical. So I was hoping that either would they be able to speak, Vatsala? Like,
Yes, if any one of them wants to speak, they should just raise their hand. We will unmute them.
yeah, sorry. So you should then feel free to speak as well. So just to give you a sense, right? I first wanted to understand from you guys, if maybe like I don't think we'll have time to maybe speak to everyone, but first, if there are any maybe three people who want to share what their understanding of financial sustainability is and what problems they are facing regarding financial sustainability, so that we can work around that first to begin with. Also, one thing intentionally, I'm not presenting any PPT decks, etc., because that takes away the interaction part of it. People then feel it's a monologue. So I'm just trying to have that chat with you. So it will be helpful if you guys are as talkative as possible.
I
So
think Kalpit raised his hand. So can we unmute him?
Hi, Vaibhav. So, first of all, just wanted to say your voice's volume is actually coming very, very low.
how is it? Uh,
Yeah,
okay, that's strange. I'm actually there.
Kalpit, it's fine to me. So please check at your end.
actually, my volume is full. Okay, so it's fine and everybody, then it's okay. Yes, you asked about financial sustainability, right? So financial sustainability again, you're asking that about with respect to the company or a personal financial sustainability.
I'm talking in terms of company financial sustainability. See, personal financial sustainability comes under personal finance.
Right.
We're talking in context of startups, right? Maybe we'll look at financial sustainability from a startup point of view.
Right. So, I mean, company financial sustainability again. Before that, I put for me what the exercises usually I do. uh, the plans that I have worked out for the next 2 years and next 5 years. So I work out in a way that right now the finance I know in terms of what the expenses are gonna be for the plans to be executed for the 2 years plans to be executed. So at right now the current position I plan it in a way that I have the necessary funds in the company to execute those of my plans that are due for the next 2 years. And again. Parallelly work for getting the things in motion for the 5 year plans. That's the general exercise that I do.
Okay, fair enough. And you believe that you're able to maintain the visibility for 2 years? Like, I'm assuming a lot of the companies here are
Right.
early companies, so I'm just trying to get that sense.
Right. No, of course, plans do change, but again, the core plan for me that the core plan is again that I have to that Apiro Energy becomes a solution provider, energy generation solution provider in the microgrid space in the next 2 years. So my
Hmm?
large plans are actually structured to that only. Now there definitely comes some sort of small changes in terms of the current activities, but
Yeah,
again, I try to take those also into consideration and then plan out the necessary finances that will be involved.
fair enough. Okay, okay, I hear you. Okay, anybody else?
Yes, we have another hand. It is Anup, I guess. Yes, please unmute Anup first. Yes,
Hello, sir.
Anup.
How are you?
Hi,
Thanks for interacting. My question for this financial stability is now we are in the growth phase. So basically we are in a pre-revenue state. What suggestion would you give us to ensure that there is a growth phase also getting impacted into it? Because problem with us is once we are actually trying to scale up, the expenditure which actually goes for just for sustaining is much more than the revenue that you will be making up. So how do you help us out to balance both?
sure. So if I understand that right, you're basically talking of a plan where you're growing, and at the growth phase, your expenditures are a lot more than the revenues you earn, because either the
Yeah,
revenue,
exactly, sir. Yes,
right?
exactly.
Sure, sure. I understand. Okay,
Thank you, sir.
anybody else? I think I've got this question from a couple of people that they're not able to hear anything. I'm trying to figure out. My mic is actually on the full volume. There's nothing much I'm able to do from here. I'm also directly speaking into the laptop itself. So
No, your volume was fine for me, sir.
it was fine. Okay.
Yeah, it is fine. It is fine. It is a bit on the lower
Just
end,
just a
but
second.
it
No,
is still audible.
no. So it is not audible for the attendees. It is somehow fine for the people in the panelists. I don't know why is that.
Oh, okay. I wouldn't know what to do with that actually.
Can you rejoin once?
Should I leave and join?
Yeah, yeah. Please rejoin.
Okay. Is this better?
Guys, please text if it is better for all.
Hi, what's up? For some reason, I think chat is disabled for me and video is also not coming.
My video is not coming to you?
Sorry?
Oh, sorry.
Now video is coming to all.
Okay.
We'll just check for the chat. Deepak, please check for the chat.
It is enabled for everyone now.
Deepak, please speak once.
Hi.
Now everyone can chat.
Vaibhav, please speak once.
Hi, can you hear me? Hello. Hello, everyone.
No, we cannot hear you.
Somebody says his voice is clear.
I was just checking with another colleague here.
Oh, some not clear. Okay. Uh, I'm not sure what else can I do. Hello. Hi, can you hear me now? Is it better?
Please speak.
Hi, Vatsala, is it better now? I've increased the volume at least wherever possible.
No, it's not coming.
Let me do one thing. Okay.
Vaibhav, please try to join with the earphones. Sir.
Is this better now? I'm speaking from. I've joined from my mobile phone as well.
Yes,
Please
sir,
speak
you're
once
audible.
again.
I'm saying I've joined from my mobile, so that the audio comes from there. Is it audible now?
Yes,
Yeah,
yes,
this
it's
is audible,
audible
sir.
now to everyone.
Okay, perfect. So maybe then, yeah, we'll just work it this way, if that's okay with everyone.
Yeah, it's okay with everyone. Thank you and sorry, guys, we didn't
No,
know
no,
that
no
he
worries.
was not audible.
So
So
sorry the delay. Now, I think so. There were a couple of questions regarding. There were a couple of points. One was regarding expenses during growth phase versus revenue. The other one was regarding just during the planning itself. So I'll tell you my version of what I believe financial planning, at least in my senses. So one is that, see, it means to have a financial stable foundation that allows startups to survive and grow over a long period of time. Now, I'll give you an example of what that means, because this sounds like a bit of jargon, right? Now, what this means is that when we think of a startup, right, a lot of the media frenzy around it actually is that so and so startup has raised this much funds, and then they've raised another set of funds, and they've raised another set of funds. And the funds you raise, the more successful you are, right? But what you don't realize a lot of times is that there are a lot of startups which are in very silent way building a very stable foundation of their business itself. While what they would have done is just
taken a loan of a certain amount from either family or friends or their personal savings, or even taken some amount of equity investment from friends or family. It doesn't need to be a big venture fund itself, right? And with that initial seed capital, they'll start to build the foundations of their business so solidly that after a point, it doesn't matter like whether they're raising funds or not, but their business is growing, right? Now, to me, this has like a few things that it allows. One is the longevity of the business. It creates a resilience that even in economic downturns, right, your business is able to survive the period. So whether there is a period where suddenly your business is out of fashion for venture funds, or whether the industry is not cool anymore, or there is no investors in the market itself, right, you will be able to survive because your business is profitable. Eventually, such businesses also happen to attract investors because they're seeing a profitable investment come through, right? But what it doesn't mean, financial sustainability to me, is that it doesn't mean that it is an exercise to get fundraise happen. It is not to get yourself fundraise ready. So please bear with me in that particular way, and be very clear about it. What we're talking about is creating the foundations of your business. Now, obviously, this is a lot of in-depth conversation that we can go here. There are four parts to it that I would ideally like to just at least touch upon today. But each of these parts is very detailed, so I don't know if we'll be able to cover it today. But at least I'd like to touch upon it so that you know what they mean, right? So one is to identify your revenue streams clearly. So every business when you create, right, you need to figure out what would be your revenue streams that where you would get this business from. So, for example, it could be a subscription service. It could be that you're selling a product. It could be that there is an affiliate marketing side of a model, or it could be a consulting service also. But you have a service or a product that you're delivering through which you're getting income. Now, a lot of times it's better sometimes, like once you have that one focused way of getting income, to also add on other sources of income so that you have a combined wealth that is coming through in the company. For example, if you think of banks, right? Banks' primary source of money earning is actually loans. They lend money through the deposits that they've got from people, and then they eventually lend that money at a higher interest so that they get their difference. But on top of that, they sell investments, they sell insurance, just because they get multiple avenues of revenue. The second, apart from revenue, is cash flow management. Now, what that means is, in cash flow management, that you have to maintain a positive cash flow to cover your expenses and investments also, right? And we'll come to this part, the part which came in earlier, and that is the fourth part of the problem as well. Now, a part of this cash flow management is also about like timely invoicing, managing receivables, maintaining a cash reserve within the company itself. So not overspending beyond what your means are, right? So I'll quickly stop here and maybe ask you guys. So if you had to give me just one example, right? It doesn't have to be a startup only, but any company that you feel that has one revenue source, but has done extremely well in terms of doing that revenue source positively, that it can fund multiple other businesses that they want to get into. Any ideas there? Like this talk, let's talk about the first part, revenue streams here.
Yes, Soma, please, you are here. Please, you can unmute yourself.
Hi, thank you, Vatsala. Hello, Vaibhav sir. Somat here. So I actually had a question, but regarding the question
Go
that you
ahead.
asked right now. So ideally, we would like to stay cash flow positive always to be able to maintain an infinite runway. That's what we've been able to do to a large extent. But what tends to happen is that as we continue growing, particularly the larger organizations, they are the people who have the maximum resistance in terms of offering advance payments and tend to request for or ask for maximum credit timelines.
Yeah.
So while we definitely want to service these customers, it becomes challenging to maintain a cash flow when we're working with such customers.
Yeah.
Secondly, as we continue growing and as the turnaround times are shrinking, it becomes important for us to maintain, although all our orders are made to order, so we maintain raw materials and all our the requirements that come in, and we make them to order. But we need to maintain larger and larger reserves of raw materials to be able to service larger requirements in time. So again, that requires more blockage in terms of inventory. So
Yeah.
these are the two problems that we are facing in terms of continuing to maintain an infinite runway, so to say, and not having to depend upon external funding.
Sure, sure. So that's a great problem, right? Actually, maybe I'll just do one, I'll explain the other two concepts and then we can get to this also. I'll use this only as a case study, maybe to start with, because then it will also give you a sense of where I'm coming from. And we can work with rough numbers just so that you get a sense of like where we're coming from, right? So the third point is, which comes to is like, so the first one was revenue streams. The second one is cash flow management. The third one is cost management. So you have to figure out what your fixed costs are, what your variable costs are. How do you balance the two so that you're not getting overspent? So, for example, not getting a very fancy office very early stage in your company, right? Just because that's a fixed expense, whether you have revenue or not, it will keep incurring. Wherein if you get a quality material, there is a chance that customers might still be willing to pay more for it, right? So that's a cost management tactic that you'll have to adopt. And the last one, which is the one that I think most of you have been having, and the discussion we've been having as well, is about profitability versus growth. How do you balance the reinvestment in the business for growth while still maintaining profitability? So uh, now to maybe start with this piece itself, right? Let's take an example where say you're a company, a very early stage, which has maybe raised about 50 lakh rupees to begin with, right? Now you have 50 lakh rupees of worth of equity and you've given that and you use that in your inventory, you've used that in your product development, etc. And you have certain expenses also that you have. Now what happens is that imagine on a monthly basis you have 5 lakh rupees of fixed expenses and you have to have an inventory of maybe 20 lakhs that happens on an ongoing basis, like on a monthly basis. But your payment cycle is now imagined to be 90 days, right? The problem is you will be able to now have an inventory only for uh, 2 times maximum because your runway itself will be short for 2 months. So in this case, right? So what you'll have to first do is that they're saying that okay, maybe 20 lakhs is a little too much for me. So I need to do a shorter amount. So maybe my amount has to be 10 lakhs. But if you say no, my order quantity itself is 20 lakhs and I cannot go below that, right? One of the things is then you'll have to figure out that if my funding itself is too low. See, because what happens is there are funding that happens at two sources. One is equity and the other one is debt, right? What you start off a lot of times is with a little bit of equity. When your business is profitable for a certain amount of time, then you're in a position to raise debt also from either banks. There are banks also that give out loans to startups now, or you're able to raise debt from certain NBFCs also, which are willing to give now loans to startups, which are typically like they're called AIFs, which are giving venture debt also available to startups. Now, in both these cases, right, you are able to at least get some access to debt. Now, that can solve the working problem, capital problem, but that is after 1 or 2 years of the company being operationally profitable at some point. But for companies that are maybe in that earlier journey, right, one of the things that is very important to make sure is that you're not going out of your way to from the equity that you have, that you're over leveraged. And what I mean by that is that in this case, if your monthly expenses are 5 lakhs, you want to maintain that, okay, I should have maybe 6 months of uh, life to work with, right? So you need to have 30 lakhs there. And then maybe the 20 lakhs is the working capital that you have, but then that you have to use across 3 months because your payment cycle is 3 months. So in that case, even if you're living on the edge, you'll have to maintain that 20 lakhs and divide that by three. So that should be 6.66 lakhs ideally. And that should be the amount of working capital that you need to operate with. So what will happen is you might feel that that's stemming your growth to a certain extent, right? You're feeling that, oh no, but I've got an order worth 20 lakh rupees and I want to fulfill it. But your payment cycle is 90 days, if that is the case. And in 90 days, if you're going to get that right, what will happen is for the first 1 month, you will get that order. You might fulfill that order also. But for the next 2 months, you'll probably be paying fixed costs and salaries without having any money to actually get any deliverables out there. So this is it's a classic step ladder case where what you have to do is have some higher equity and then have some extra debt being able to do because you constantly have to juggle between how much capital you have. So when your company is generating enough amount of cash reserves, right, then you're able to do it. Now let's take a cash flow example here where 90 days later, when you deliver goods worth 20 lakh rupees, imagine your gross margin there is 50%. So you are getting 30 lakh rupees in total, right? So if you're getting 10 lakh rupees every month from the third month onwards, if that is the amount that you went with initially, right? You will get 10 lakh rupees worth of extra money in the third month. But that still not suffice to have another cycle running for you, which is additional cash flow, right? So either then what you should do is start with 1 crore of capital. Now, because if you have 1 crore of capital, right? If 90-day cycle, your working capital is blocked at 60 lakh rupees for 3 months, right? Then in 40 lakhs, the remaining amount that is there, you will still have a working capital amount left for 8 months. And in 60 lakhs, you will be generating in the third by the third month. If you're generating every month additionally 10 lakh rupees, right? In the next 1 month itself or next 2 months itself, basically by the end of third month and by the end of fourth month, you'll have additional capital for one additional 20 lakh rupees, right? And that will free up your working capital requirement, and then it'll help you scale up faster. So this is the critical mathematical element that you will need to do to first figure out what is your fixed cost, what is your variable or the working capital cost, and balance the two, right? Because if you're not balancing these two costs, right, then it becomes very hard to make sure that you're able to go for it. Now, the other way to solve this problem is also, which is sometimes a good problem to have as well, that if you have investors ready to actually pump in money to your company, then you can obviously do it. But there also, one of the things is very critical is that I've given you an example of a case where it is a 90-day cycle. But what if your cycle is such that you start manufacturing, say, in summer season and your actual sales happen, say, during Diwali? So you have a 6 to 9 month cycle. By the time you produce your goods, you sell them in November, December. That's a long cycle. In that, you're also running the risk that in case if there's something happens, right, then the entire inventory that you have is it can completely like be lying around with you for another extra year as well. So what you need to do is still maintain enough equity in that case that you have a survivability not for just 6 months or 8 months, but at least a year in that case. See, uh, the equity that you've raised needs to allow you to sustain at least for a 12-month cycle. And that will allow you to have that comfort that whatever is the leftover, I can use in my working capital. So that benchmark will help you a lot in terms of figuring out that how much can I use for growth capital. Because if you don't, right, what will happen is the moment you're running in the third, 6 months, end of third or 6 month, you'll be like, oh, I'm running out of cash, but I need, like, my business is growing. What do I do? Right? And you'll not have a simple solution for it. This is a very critical element for you to consider that if I've raised some amount of equity, will that help me survive for 12 months? So that then you're not thinking of your day-to-day expenses from your current setup today, right? And there also, I would say that having that business plan is very important because what will happen is in that 12-month period, right, you will have increasing amount of expenses. What I mean by that is that today in your company, you might not require, say, either a chief business officer or head of sales, but 6 months or 9 months down the line, you may believe that that is a requirement. Then what are you going to do about that? So I think that is a very critical element for you to consider. Does that answer your question, Samar, to a certain extent?
Yes, it does, sir. Thank you so much. I'll need to look into the details, but thank you so much.
Sure. Do you have any follow-up questions on this? Like just to begin with?
Um, it'll probably be too detailed. I think I'll
Okay,
I'll try
fair
and
enough.
connect.
Sure, sure. Sounds good. Okay. Okay. So now we touched upon this particular part at the end, like at the end of this discussion, right? About budgeting and forecasting also. Now, this actually is a very critical part for you to exercise that in the 12-month period, see people like when you meet investors or banks or anybody else, right? They say, give me a 5-year plan. In my experience of running a startup for 10 years, I can tell you one thing for a fact that even at the end of 10th year today, because we're still a startup, we are unable to do this long-term forecasting, which is more than a year, which is I can do with confidence. My second and third year itself, my confidence level starts to shake because the confidence I will have in my numbers for 1 year is a lot higher than the confidence I will have in my numbers for the second and the third year. I'll tell you why. I run a lending company, right? I started the company in 2015. Since 2015, let's just take a look back at the kind of incidences that have happened in the last 10 years itself, which will give you an idea why planning for more than a year or sometimes max 2 years is impossibly hard. 2016-17, we were hit with 16 early, we were hit with the NBFC crisis, right? Then 2016 end, we were hit with demonetization crisis, which lasted for almost 6 to 9 months. Then after that, we were hit with banking crisis that happened in 2018-19, where like a lot of banks were also shut down. Then 2020, we were hit with COVID, and like just when we came out of COVID is now when suddenly there is like an upside clearly, but suddenly RBI has come out with a lot of norms for us. Now the thing is, these are outside scenarios which are completely out of my control. If I start to say, this is what my 5 year projection looks like, right, and I will live by it, it's impossibly hard for me to do that. This is, I'm just saying as an honest conversation, but obviously you will still be asked for these 5 year numbers by every investor and every person you meet. But when you are thinking of a business more as a sustainable business for yourself, right? Just keep that in mind, at least for your own sanity, that my numbers are good to go for 1 year. That I will have a very strong pull over because I need to know which people I need to hire, what kind of what my company needs to look at the end of 1 year. But yes, beyond that 1 year, it will be hard for you to know what kind of company your company will look at exactly. And sometimes having these gradual steps also, right? They help you go by what you have at the company at the time rather than trying to make plans that may or may not work. So 1 year down the line, suddenly you may get a big order and your company might look completely different because they have given you an advance. So you don't even need like say venture capital or venture debt or a bank loan. But at the same time, if you've not got any orders and you're still like absolutely right at the edge, then having that sustainability will help you a lot to make sure that your company is not going off the hooks, right? So that is one. Now, I also wanted to like just touch upon this cost control part that we spoke about a little bit earlier. Now, see, at early stage, especially say year one, two, right? There are a lot of expenses that are non-core activities. So there, I believe to have that cost control part, hiring freelancers or people who are not full-time on your roles is actually a good way to do it. But the moment you have an established role for these people in the company, then you should get them in-house. So for example, if you don't need a graphic designer initially, maybe have somebody as a freelance work for you, or even a recruiter, for example. But the moment you have like consistent requirements for recruiter, right, then hire one. The same way with say using of technology also. That as long as you don't have a requirement for like consistent marketing, right? Like so either a CRM or a marketing automation tools, you can start like starting with manual process. But the moment you say that no, this is becoming consistent part of my work, then start using the technology to get there also, right? The same is that initially when you're like buying very small sums, like just for testing, right? Then maybe haggling too much with your vendors may not have that much of result. But the moment you know that, okay, now I need to get like certain amount of value from my goods, then negotiating with your vendors will help you a lot because obviously then you can reduce your cost measures. Now, one thing that you should do, even going forward, right? Like figure out like the top three costs in your startup and brainstorm with your team what are the ways to reduce them. Like because the cost will always spiral. See, we've also, I don't know if you guys have been in the frenzy of the startup world today or not, but we've also been in this frenzy in the last 4 years where there was a ton of money that is available in the market and people were throwing money at problems. Now we are not in that state, and I don't think we're going to be coming out of that state anytime in the next 2 3 years also. So most companies have to be built in a sustainable way, and that's actually the good way to build it also. Because when money is not thrown at problems, right, you're very conservative in what you're spending on. You're very clear with your spending measures also. You're not unnecessarily throwing money because it's a fashionable thing to do. You're not attending random conferences because like it's a good way to show on a LinkedIn post, right? So I think that sanity will definitely start to come in. So just keep a measure on that as well. Now, one thing I wanted to also touch upon in this financial planning itself is that the milestones of each company will look significantly different for also what stage of the company you're in. For example, if you're a seed stage company, Series A or Series B company, your stage of development or your models could look very, very different. at that time, the need for equity or debt will also change significantly. Now, like, see, give you an example of why I am talking about equity and debt enough, because maybe a lot of you may have not dealt into debt enough so far, and you either may have got some grants, or you may have raised some equity from angels or maybe small VCs. But what the pros of equity, right? One to me is that it's money which you don't have to pay interest on. So what happens is that if your business does not have revenue today, then you will be able to raise equity so that you know that, okay, I will not be able to service this debt. So it's a good thing. Then I'm raising this money so that I can build this business out of it, right? But the moment you are raising money for growth, and this growth means you need money for working capital. In that case, I would say equity is a very, very expensive way to raise money. Then go for debt. Because what will happen is if your working capital requirement is only like a 6-month cycle or a 3-month cycle, right? Your profit should be able to take care of the servicing of the debt. What I mean by servicing of the debt is whatever the interest rates are, whether you're getting 15% or 20%. If you're per year, if profitability is allowing you to give that 1.5 to 2% per month additional from the interest, right? Then definitely go for debt. Don't try to raise equity there, because otherwise it'll be a waste of your equity. See, equity is very precious. Each time your revenue numbers increase, right, the valuation of your company also increases. But each time you have raised more money, the personal holding of your own in the company reduces significantly. And what will happen is the moment you come into single digits in your own personal holding in the companies, right, you will start to feel less motivated to work for your own company. And that is not a situation you want to be, because each equity round means that you're diluting further, right? So this is like one just very quick way to look at it as well. I think one thing I've also seen companies do a lot is sometimes between long-term financial decisions and short-term fixes. So I'll give you an example of this, and maybe after this, I'll ask people also to share some example that you feel could be one. Imagine you're creating a prototype or an early stage model of a product that you want to develop or a machinery that you want to develop. Now, one way is that you have envisioned a full-blown factory which has these materials and like this sustainably amazing looking machinery. But one is that you get second-hand materials from these factories and you fix them up to actually create this model. What at what level should you use this quote unquote jugaad versus how much you should use the actual like in long-term goal, right? That's a call that you will have to take every moment when you're measuring it, because that will depend on the amount of money in terms of cash you have. That will depend on the amount of like how far out that vision is in there, and what level of development you are in. So I would say that if you divide your progress of say the machinery or product in 4 phases, right? You're like, oh, this is my just alpha prototype, and after that I'm going to come with beta prototype, and then a production prototype, and then finally a model that scales. Then maybe don't build the Taj Mahal on day one. Don't try to do that on day one itself. Then do make sure that you're just doing whatever it takes to make sure that your model works. There is validation that you're able to get of your model from the market itself. But if you feel that you are almost there, you've reached the beta or the production level, and now you have to get to the next level, then maybe create that smaller level of factory or that output that you have to create, just so that you can show that, see, maybe this is a 1,000 square feet factory that I can run like clockwork for me, and here I can produce say 1,000 units of goods per month. But then if you had to show an investor or even a bank that, see, with this 1,000 square feet factory, I'm able to produce 1,000 units per month. But at the same time, if you are able to give me, say, a $1 million equity or a debt more, then I can create the same in a 10,000 square feet factory, creating it not just 10,000, but maybe 20,000, because I have economies of scale and I'll be able to conserve a lot of costs, right? Then people will believe your story. But the thing is, at some point, you need to get to that point where you can create that 1,000 feet factory also. I think that is a very critical part in terms of work. Again, I'm giving these examples assuming that every one of you is in a very different business. So not every example will fit everybody's case. But I'd love to hear specific questions now so that I can also make sure that it doesn't become like monotonous for my end, but also I'm addressing questions that you have specifically with respect to some of the financial decisions that you have to make for your companies. Any hands here?
Guys, anyone of you who wants to interact, please raise your hand and we'll unmute you. Yeah, we can go ahead, Vaibhav. Okay, there's someone.
Okay.
Please unmute Priyanshu Deepak. Priyanshu, you can speak now. Priyanshu, you need to unmute.
Yeah,
Yes.
I just want to have one query regarding the discussion we just had previously regarding the working capital issues. I think that's one dilemma that we keep on sort of facing, whether we should go for because mostly once you are in sort of in a post revenue stage, for growth actually what we need is working capital to support us.
Yes.
And it's always and the problem what we I believe will face is that where to raise the debt. Because if we go down to the bank, even though one of the major problem we have is with the collaterals and stuff like that. So give us some idea about what will be the best way to go for debt funding. That's something which we are very would like to really understand it better, because it's something like we all are aware of it, but then how do we go about it? Because finally the banks have their own sets of rules and regulations.
Yeah. No, I think so. That's a good question, actually. And I think there are some of the banks that are already doing it. In fact, like I'm aware of certain SIC companies only that have been able to raise debt for their working capital from banks itself. So I think that is something that, like, when you speak to the mentors at SIC, right, they will be able to help you with the specific banks, because some of these are also branch dependent. For example, like which city, which area you are in. So it is not necessary that like you say that okay, only I will apply to this particular branch and it will work. It has to be the area that you're in, because that branch or that bank also needs to exist at that area, right? This is my assumption here, but I presume all of you are not based in Kanpur here, and everyone is in different cities. So in that case, it's also imperative to understand that okay, what branches and banks are available. But I think Vatsala can second me on this. But there are programs that I think SIC has also been able to figure out, where banks have been able to give loans to startups at an early stage also. Like I think one or two of my mentee companies have also been able to raise debt from banks.
Okay, I'll definitely get in touch with SIC
Yeah.
for that, because yeah, you are right in a way, because when you operate from different geographies, we
Yeah.
always have this problem, because we were initially started off in Assam, and now we are operating from Delhi. So
Yeah.
so this kind of issues do keep on coming up, because
Correct.
companies stood in Guwahati and stuff like
And
that. Yeah, sure.
I'll give you one more piece of advice here. Because I work in a lending company itself, I can tell you this. See, there is bias in lending across the country. Okay, so don't hold me on it, but like the fact is that certain areas, certain geographies are considered less credit worthy than others, right? So if you are able to show your residency of company, etc., from Delhi, then the chances of like getting a loan is a higher than, say, for example, getting a loan from Assam. Hello?
Right. That's true. In fact, we are realizing that once we started our operations in Delhi around 6 to 7 months back, and yeah, we do get to understand that there are definitely certain some schemes we don't even knew that there's some schemes which are available back there in Assam. Yeah.
Yeah, exactly. So that there's always that case where, because what has happened is traditionally some areas, like I'll just give you an example for that matter. My wife's from Calcutta, but Calcutta has very poor lending history. So that's why all NBFCs operate in all big cities in the country, but they don't operate in Calcutta. The same way, Kerala is the most educated state in the country, but like most lenders, including ourselves, don't operate in Kerala.
Right. Right.
So
Thank you. Thanks.
there is always that bias that is there. You just need to make sure that at least you're on the right side of the bias at least for that.
Right. Right. Sure. Thanks.
Any other questions? If you don't have questions, I'll start asking questions now because I also want to understand like how much you are aware of this.
Yes, Sumat has something to say. Sumat, please unmute.
Sir, this might sound quite generic, but I just want to get your point of view on this. So, if you want to build or procure equipment to unlock economies of scale, should we take the debt route or the equity route to finance that equipment?
Would you consider the equipment in the as a like okay? Let me rephrase my question. Sorry for that, but I'm saying, does your equipment requirements vary based on how much output you need to have, or is just a one-time requirement that you have?
It's a one-time requirement that can unlock economies of scale. Yeah.
Okay, so if it's a one-time requirement, then I think equity is great for it, right? Because there you equity then becomes easier to for you to do it once, and then you're able to like completely get economies of scale, and then either raise debt or raise equity based on your condition of the company that period later, right? But what will happen is raising debt without really having that much amount of revenue becomes very hard, right? Equity is great when these are like one-time expenses or like so for example brand building, right? You see a lot of these startups they putting in a lot of money, but because they say that this is a one-time exercise of me building a brand, right? Once I build my brand, I don't have to constantly spend that much amount of money on cashbacks and offers also, right? Which is what truly we've seen also in some cases. Paytm used to give so much of discounts earlier, they don't do that anymore because they're creating that one-time brand, as they say. But if it's recurring, then it might be useful to have a working capital or a loan or debt taken. That might be a second case, but I don't think that is required in your case if you're able to unlock economies of scale in point one itself.
So, as a rule of thumb, generally for recurring expenses or working capital, debt is better, and for one-time expenses, equity is what is suggested.
Yes, I'll just add a caveat here. In equity, also it depends on how much amount it is. See, if it's a reasonably large amount, right, then it obviously makes sense to raise equity because otherwise, but if it's a 5-10 lakh rupee difference, then raising an equity might not really make sense because you'll have to still raise a reasonable round that at least say 30 lakhs, 50 lakhs comes to you. And then you're unnecessarily diluting a company for no reason, just because you needed the 5 or 10 lakh rupees. So it also depends on the value that you need to raise for this equipment or a one-time cost that you're talking about.
Thank you. That's helpful.
Yeah. Okay. Anybody else has questions?
Not
Okay.
at this point.
Sure. So I'll ask you a question, right? Typically, like if I had to think of it, uh, what revenue models actually don't work in India? Or
E-commerce
are very hard.
for
Sorry?
small value products. E-commerce for small value products.
E-commerce for small value products. Like, give me an example of value.
Under 100 rupees.
I can dispute that a bit because, say, for example, fruits and vegetables are still being sold on e-commerce and like likes of Blinkit, etc.
E-commerce seems to have untapped that, but otherwise it seems to have been tricky to make this profitable generally.
No, of course. See, slow commerce it has, but what they do is they've started to charge money on it, right? Like they say that okay, your order value has to be minimum 150 for a free delivery, for example.
Yes.
So as long as you're getting that money some way or the other, whether it's like in this or like through delivery, you are able to make that ends meet. So I think there is a solution to it. What else do you think is it does not work? And this is primarily due to psyche of the customers. So I'll probably give you the answer here. The model that doesn't necessarily work in India as successfully as it does in the West, right, is actually subscription models, right? And I'll tell you why. So subscription in the US or Western world is a very common phenomenon because they have actually been used to one trust economy. So India is a trust deficit country. What that means is that between you and me today, if I had to ask you for $100, you will suddenly be like, "Oh, who's this guy? Why is he asking me for 100 rupees?" And you'll be like, "Okay, I don't want to give it." That's why people are very wary of even keeping debit cards and credit cards in their pocket. They're like, "What if it gets lost?" Right? And that still happens with like your parents' generation. You'd have seen they're very wary of cards in general. They're like, "No, no, we don't want to keep this." That is one, which is the trust deficit that we have. And what leads to that is in subscriptions, people just don't want to have this thing that, oh, something is getting cut on a monthly basis. And I don't even know about it. Why is that happening? And one example of that we see, right, is even in rentals. So you would have seen that like most people in India have this habit or this real ask or desire that I want to own my own house. Why? A, a significant part of that is that they want to get away from this rental mindset that I'm having to pay for the subscription of the service of this house on a monthly basis. I would rather own this thing. That is why a lease like service you have not seen grow in India as much, where in the West it's very popular. The only shades of where we're seeing this change is in the California population in India, which is more like people who use Netflix. Right there is a little bit of a change. But if you think of all the other avenues where we consider, this has not been very, very popular, right? And I think that is one way where if you're looking at subscription service, right, you might need to reconsider your business if you are able to create a behavior change. I think sometimes I also believe, uh, oh yes, great point. I just read this question from Jatin. How is it different in B2C and B2B segments? I think my example varied a lot from a customer versus B2C. In B2B, people are still very, very, those are called SaaS companies mostly. In SaaS, subscription models are fairly open. There, people are using subscriptions. So, for example, a lot of you may be using Zoho, for example, for accounting, etc., right? And you use subscriptions on a monthly basis. But that is because at some level, it is helping you in your accounting software itself, or you're using Gmail services and you're paying for it. Those are services that we are okay to pay for business because those are business expenses eventually. But what I meant is these are expenses for consumables. We usually have trust deficit there. For consumer behavior, we are slightly averse to it. But yes, completely agreed. In B2B, that aversion is less, but the propensity to pay is way lower, to be honest. So what happens is if there are softwares or services that are slightly on the lower end, people are willing to use that. But if there's software and services or products also that we get subscription basis that are slightly on the expensive bit, we don't want subscriptions. So if your business model is sustainability depends on subscription, right? Just be mindful of that, to be honest, and take care of that. Jatin, you had a question? You want to unmute yourself?
Yeah, hi Vaibhav.
Hi.
Yeah, thanks for considering it. So, so I want your perspective on. So, for example, so we build solar panel cleaning robots
Hmm.
for rooftop, and they have fairly high capex. Like the machines, considering the machine cost and technology, and somehow, like I feel like customer are more conducive if there is a lease model or a subscription
Yeah.
based model. So is it like, is it, why is it so? Like, is it because the technology is new, it's not being established as a standard practice, so they want to keep the risk appetite low, or there is any, or they just want to keep, even in a mature technology, similar thought process is there that they would want to lease rather than buy. Uh,
So in this case, right, it's because it's untested.
mhm.
See, what is happening is you're talking about the top 10 to 20% of the population in the country, maybe not top 10 also, maybe top 5 itself, of the country that is moving in that direction. So they are always worried that what if I have to go back, right? So you have to see mistakes from people in two possible ways. One is mistakes that are non-redeemable, which means that you can't go back. So, a very random example of that is getting married is a non-redeemable mistake. If you choose your partner wrong, then it's wrong, and you can't change it. But there's some mistakes which are like redeemable, which are changed. Like if you took a wrong ice cream and then you want to change that ice cream, you're like, okay, ठीक है, 30 रुपए लगेगा, but I'll buy get another ice cream maybe, and that's
Mhm.
a changeable mistake, right? Here, people believe that I'm an early adopter, but I don't want to be someone who's such an early adopter that I make this big mistake where I spend, I don't know, you can correct me wrong if I'm wrong here, but like maybe 40, 50 grand on a whole setup, which suddenly like I'm not able to return anymore. But if I have a lease model, and even if I'm tied in for 1 year maximum, then I'm able to choose it, right?
Got it.
And
Yeah.
that's why in a lot of office spaces you'll see like this is a very common model that happens. People move into an office space, they first see whether they like it or not. When they have spent that 1 or 2 years, right, then whether depending upon the requirement they have or not, then they choose to see that whether this office they want to buy or not, because office rentals are about 10%. So compared to the cost of the property itself, so the property cost is 1 crore, the rental will be 10
True.
lakhs per year
Very
typically.
good. Yeah.
So then after 1 year, they decide to choose that whether they want to stay there or not. But it does not happen before that, right? That's one very classic difference that happens in some of these things also. That early adopters always have this thing that they don't want to be like fooled if something doesn't work out, because there is an element of shame involved in this.
See, I see. So just like my retrospect on this. So as we grow, even so, maybe having a lease model is a good idea.
Yeah,
But even as we grow, it's better to at least like have two options for the customer in parallel. Like they can buy it out. Maybe we set a minimum number of machines that we sell in as a capex model, and then we keep the primary as a lease model.
yeah.
So
So I think what you can do is you can give a freemium like model. This is not exactly freemium, but you can say that you lease it out for 1 year. And then after 1 year, you will have an option to buy, a call to buy, which could be at, say, I don't know, hypothetically 80 or 90% of the cost of whatever it was, because you would have already paid, say, 10% of it over the period, right? So a person feels that, oh, I'm having this test out model also for 1 year where I paid this 10%. And then 1 year later, if I like it, I can buy it also,
I see, I see, I see. That's a very useful input. Thanks.
right?
Yeah, yeah, yeah. Makes sense. Thank you.
Anybody else? So I know we're just running out of time now. So I hope this session had some useful elements to it. What I wanted to leave you with the thought, right, that this is actually a vast topic. So covering this in a span of 40 to 50 minutes is not that easy. But what I wanted to at least plant in your thought process, at least, is that it has four components to it, which you need to think at every possible level in your business. One is the revenue streams. What revenue streams are you coming from? uh, how are you managing your cash flows in this business, whether your costs are optimized or not, and where are you placed with between profitability versus growth. And you can take a call where your business is based on it. How much of capital do you have so that you can spend on growth versus the profitability also. And that also depends on the stage of company you're in, right? So today, for example, our primary goal is profitability more than growth at my level of company today. So I'm not thinking of growth as much as I'm thinking about profitability today. Like my day in, day out is just to make sure that we optimize all our costs, just making sure that we reach profitability, because we're EBITDA positive, but as we reach part positive, right, that adds a big color to us because suddenly we can last for eternity without really having any issues. So obviously, like we've grown significantly, but at the same time, we also don't want it to be a case where we're never profitable itself. So this is we've now taken a call in the last 1.5 2 years to do that, but it requires a mind shift change also. It requires teams also to start working in that way, because when you're in the growth mindset, right, people don't think about expenses as much. They think that ठीक है देखते हैं बाद में देखेंगे इसको optimize करेंगे. But in profitability, every expense starts to hurt. You may have three people in your training, you will suddenly start feeling that maybe one person is enough for training, I don't need three. So you'll start cutting down costs wherever it's required also. So just be mindful of that. I think these four terms are important, but I'm happy to answer any specific questions that you guys have as well, right?
Yes, thank you, Vaibhav. This was the first time when we went without a presentation,
Yeah.
and to me, it was very engaging. I hope it was the same for others. Thank you to Anup, Sumat, Priyanshu, Aman, and Jatin for your participation during the session. We look for such active participation. Maybe what I'll do is from next time, say we'll come back within a couple of weeks with another session on the financial sustainability, and I will inform in a couple of days the session that we are going to conduct on this. So if there are any specific queries, any specific points you want us to touch base on, so let me know. We will plan it accordingly for you guys. We'll tailor it accordingly.